Okay, thank you very much, everybody, for your patience. I believe it's a good time to begin the discussions now. I welcome everyone to today's call. We are gathered here, hopefully, to share our views, exchange ideas. My name is Ernest, and I'm your presenter for today. I'm your moderator for today, sorry. In the next 60 to 70 minutes, we will be gliding through critical economic topics that shape the landscape of our financial environment, so to speak. We got your feedback on the call, going beyond the scheduled timing. And so today we hope to deliver within the time frame without losing out on the salient matters as well. Our agenda for today is packed with some pivotal updates and analysis, including the current state of inflation as a macroeconomic indicator, recent developments in currency and market updates, performance of the primary auction by the government. We would also take a comprehensive look at Ghana's multi-leg restructuring efforts, encompassing domestic and Eurobonds, and touch on bilateral creditors arrangements as well. We would also talk about the impacts of these restructurings on your investment decisions. We will do a 360 overview of new investment asset classes that have been introduced into the market, and then also what current investors have as their preferences. We will draw lessons from other countries that have faced the challenges of restructuring and those that have become seasoned borrowers from the IMF. We hope that you would find everything to be discussed today informative and valuable going forward. We have with us Daniel Nilaetete as our presenter for today. And we have all of you participants as our stakeholders in the industry. And as such, we would hope that you would also come in all out and share your views and opinions on the matters to be discussed today after the presentation. Daniel is the analyst behind most of the research contents we churn out from here at Blackstar through the various channels, including our social media pages. He's done this for a while and over the time has mastered the craft of financial analytics. He would be presenting all the topics I've mentioned today, and after, we are going to leave the floor open for your contributions as well as your reactions to these vexed matters. So without wasting much time, we are already 13 minutes into our call. I would invite Daniel to begin his presentation.
Yeah, thank you very much, Ernest, for the humble introduction. I hope you can hear me.
Yes, we can hear you. Affirmative.
Yeah, okay, awesome. So, like Ernest mentioned, we're going to be having a discussion about where the market has come from and where the market is going. And I think over the past 2 years, I think we've done a very good job at keeping the market up to speed on what is happening on the market. We've had various discussions on Ghana's economy, where the banking sector is, on green bonds. We've done conversations on the PE industry, etc. Today, we are going to look at something that the market has been looking forward to see. And I hope that you would follow me throughout this presentation and try and pick at least one thing from each slide as we go ahead in this edition. So without wasting much time, find my laser. Okay. So on the market update section, there's good news on the market really. And over the past 1 year and 6 months, we've seen a slowdown in the pace of inflation over time. We started the year 2023, but after ending 2022 at around 54%. But over time, we've seen that gradual decline in inflation space over time. We've seen a lot of measures that the Monetary Policy Committee has taken over time with the introduction of CRRs, with the reduction in rates, with the increase in rates, just to make sure that they have the money supply in the system under very good check to also make sure that we see a disinflationary environment, looking at the kind of things that we have in our economy. What we have also realized over the past 1 year and 6 months is the trend that inflation has taken together with core inflation, which excludes energy and utilities. We see that they've taken a much similar trend over time, and we expect that going forward, we'll see a much similar trend going on to the end of the year. Now, what does this inflation trend mean if you compare Ghana to other African countries across the continent? And what it says is that Ghana's inflation, even though it's very low, it's part of one of the highest that you can see in Africa. Yesterday, Nigeria's numbers came out. Nigeria posted around 34.2%, I think 34.19% last yesterday for June. You look across the continents going far to the east. You look at Ethiopia. Ethiopia was around 20%. You look at Zambia, and it's around 15.2%. And the idea is to give you a clear picture of what is happening in terms of inflation across the continent. We are not anywhere close to where we want to be at the end of the year. Remember last year when we were about to finish the year, the Ministry of Finance came out that they had a 2024 target of around 15%. So even though we've seen a disinflationary environment in the past 1 year, 6 months, we still have a very long way to go in reaching upper and lower band that we've set for ourselves as a country. Now, what the lower inflation levels has meant is that government is also borrowing at a very cheaper rate because we've seen a slowdown in the pace of inflation over time. In 2023, at the primary auction, we ended the year around 29.2 for 91-day bills. We ended the year around 32% roughly on 182-day bills and 33% for 364-day bills. And between the start of the year and up until now, the BMS have done a very good job in reducing the rates at the primary auction. 91-day bills have dropped about 445 basis points. You see also 182-day bills, they have seen the largest drop. And amidst all of that time, you saw that at the start of the year, when rates started to drop, the market reacted. The white line that you see here is the target that government sets for itself at every single auction since the start of the year. And the green one that you see is the accepted levels that we've also seen since the start of the year. So at the start of the year, when the market was shocked with a drop in rates at the primary auction, you realize that a lot of people went into T-bills just to lock in rates. And that's the huge difference that you see around this period. But over time, you've had various sections in the year where government was not able to reach its targets. Here, for instance, around April, when it wasn't able to meet its targets. And the very recent one that we've seen is in last week auctions, where government set a target of around 4.7 billion, but it was not able to meet that target. If you put that aside, if you look at the whole year from the start of the year up until last Friday overall, government has set for itself a target of around 103 billion Ghana cedis, and it's been able to meet that target, raising around 121 billion within that period. So if you do the math, it's in excess of around 18 billion. So government has really done a good job for itself by reducing its rates at the primary auction based on the trend that we've seen in inflation as well. Now, moving on to other things that concern the markets. Inflation has been one of the major headaches for government since the start of the year. I mean, since the start of 2022, since we saw Russia invading Ukraine, we've seen our currency move in very wild ways. 2022 alone, we depreciated around 39%, which you can see here. Last year, we did around 16%, and now we are already around 22%. Having started the year around 12 cities, now we are all the way up at 15.4%. So it's not been a pretty good story in terms of currency. We've seen a lot of inflows coming from our international creditors, etc. But we've not been able to have a very firm grip on the trajectory of our exchange rate. And that has been a major headache, like I said earlier, for the Ministry of Finance, for the Bank of Ghana, and for all other participants on the market, really. So there's a good story in inflation. There's a good story on the auction for government, but it hasn't really been an exciting story for Ghana when you look at it exchange rate wise. And like we always see, we've based on the research that we've done, we've not seen a single year that the Ghana cedi has appreciated against the dollar, and hopefully from next year going, because it doesn't look like this is going to turn around as we find ourselves in an election year, but hopefully in the future we'll see a much more stable currency going forward. So how does we've looked at the primary auction? How does the market look in terms of the Ghana Stock Exchange? And also with that, we've seen a lot of positives on the markets with regards to the stock markets. We've seen Unilever, for instance, they're up around 82%. You see GCB, you see MTN around 43%. You see GGBL, you see Total, Atlantic Lithium, and Funmail, you see Bob. And the market has really rewarded some of the companies that have posted very good numbers. And for just reference, if you want to see some of these numbers on these companies, we posted quite a number of them on our LinkedIn platform, so you can take a look at them. And one of the very stellar performers this year, in terms of full year numbers for 2023, was Unilever. And you see that the market has really rewarded them. For some of the companies that you see at the very far right, which is Societe Generale, Das Pharma, MMH, Cowbank, Enterprise Ghana, you realize that at the start of the year, there was some news on the market that Societe was going to exit the market. So you saw people reacting in that regard, selling off on their shares as well. You see Cowbank also, when there was an injunction on their rights issue, you saw the market also reacting in that way. So now currently they are down around 29%. So holistically, looking at the stock exchange in general, in total return basis, non-financial stocks have returned around 27% roughly, and financial stocks have returned around 9.26%. So it's a very good story in Ghana for now, if you are somebody who believes in the Ghana Stock Exchange and the Ghanaian markets in general. So sometimes it's very easy to get lost in such a euphoric environment. And that leads us to ask this question. So what markets do we currently find ourselves in? And that is what we all have to come to terms with. And what that means is that it's a market that has gone through a domestic debt restructuring. You remember in 2022, in Jan 2022, when our macros were deteriorating, we had inflation going up from a base in 2021, where we had our lowest inflation levels. We saw FX skyrocketing. Then the Ministry of Finance came out that they were going to seek support from the IMF. Then after that, if you were an international creditor, they suspended all your payments on coupons and maturities, etc. Then in around 29 December 2022, government said that it has reached an agreement with the IMF so that it will come and help us with putting our economy in place. Then from Val's Day 2023 up until 13 September 2023, government was able to, by some way, reach an agreement with domestic bondholders to take haircuts on some of the coupons that they were expecting in terms of the holdings that they had. You saw a restructuring on cocoa bills, now cocoa bonds. You saw pension, the pension funds also receiving an agreement with the government. You also saw a restructuring on dollar bonds as well. Then we go through a period where if you are an international creditor to Ghana, let's say I'm a Ghanaian and I made an investment in Lesotho. And for the past, since December 2022, government hasn't paid me anything. And up until now, government is now trying to reach an agreement with me. So if you put yourself in the shoes of the international investor hasn't really been happy about the way things have gone. But in 12th Jan 2024, government came out that they had reached an agreement with the official creditor community. Then in April 2024, government came out that, okay, it had made a proposal of about 33% haircuts for Eurobond holders for them to undergo a restructuring. And then also news came out that the international creditor community weren't so happy about the deal that was drafted. So they sent government back to try and redraft one that works best in their favor. Now, there's good news. And the good news is that government has been able to reach that deal with bondholders. And as the Financial Times captures it, it says that government strikes deal with bondholders to end debt defaults. It's you can't take away the fact that these gentlemen that you see on your screen have done a very brilliant job. We shouldn't have been in the place that we were in the first place. But if you look at the kind of struggle that the likes of Zambia, etc., have gone in to try and reach a deal with the IMF in terms of even restructuring their debts, you'd have to give a little bit of credit to some of the work that these gentlemen have done. The former minister is no longer part of the team, but you see that even with the succession plan, it was very easy for us to get things over the line in terms of reaching a deal with the international creditors as well. So this news is good news for the markets, and hopefully, if government should get the consent from all Eurobond holders, it would be very good news also for Ghana going into the future. So what has been the reaction? And the best way to look at that is to look at Ghana's Eurobond index, which is a black star indices that we built to track the performance of Eurobonds that Ghana has on the market. So the reaction is at the very tail end here if you follow the laser that I have. So since Ghana reached the agreement in principle with the international or the official creditor community, you realize that there was a brief rally in Eurobonds. But then after you saw that anyone who wasn't really excited about the deal ended up selling off. And then you saw the drop that you see here around this period. But generally, since governments mentioned that they were not going to pay any external creditors in December, like I mentioned in the roadmap, Eurobonds in USD terms have done around 42%. And that's in USD terms. If you look at how much your currency has performed within that same period, in 2022, your currency lost 39%. In 2023, like I showed you, you were down around 16%. And in 2024, you're already down around 22%. So if you put that into perspective, those who had invested in the market, even as of December 2022, may have made appreciable gains by still being or still holding on to the Eurobonds that they have, even prior to the agreement with the official creditor community. So I've spoken about the deal, but someone will ask, what really is the deal about? And that's what we see in this new slide. So in a nutshell, government says it wants to restructure its 13 billion debt, right? And what it has said is that it has reached an agreement with the official creditor community, which is on its external debt, that, hey, I want you to forgo about 4.7 billion of what I owe you. And the truth is, I would also need you to provide cash flow relief of about 4.4 billion, even as I go through my IMF program, to make sure that I reach a very sustainable debt level and also make sure that my economy is running in the way that it is supposed to run. Now, that is the snapshot at the very top level. Now, what does it mean? What it means is that if you consent to be a part of this program, they have two sections which they are split. So they have a power section and they have a disco section, which we have here. So if you choose to be a part of the program, they have a cap on the number of, the quantity that can go under the power option, which is around 1.6 billion. If you end up being around under the power option, you would have about 3 bonds. If you go under the disco option, you would have about 4 bonds. Now, on the power option section, it has a very low coupon rate of around 1.5%. So that cap of 1.6 billion altogether lumped up would have around 1.5% in terms of coupon on that. And those people will not receive any haircuts. Now, for those who go under the disco section, which will have around 4 bonds, you are going to have a coupon of 5%, but with time, that 5% will grow into 6%. So that is the deal in summary. Now, the deal doesn't only include financial terms. Now, the creditor community has grown so much over time that now they put in clauses that would make sure that their debt restructuring ends up in their favor. And that is what we have here. So under the non-financial terms, the official creditor community is saying that, hey, because you want to undergo this program and because you want to make sure that we we are in a better position, what you are going to do is you are going to publish your debt information semi-annually. We want to see that semi-annually. Also, you need to ensure that we, your creditors, we do not, in no other person gets a better deal in net present value terms than we have done. What we also want is that if certain events should happen, if your economy should turn around, we want a loss reinstatement. The losses that we're supposed to incur, we want it to be reinstated until 2032. Now, we've seen that there's been very few changes in your market. What we also want to ensure is that you have an estoppel provision that prevents you, the government, from raising any legal challenges against the new bond. So you can see that in this deal, the international creditor community has a very specific stance in realizing that there's there's transparency in knowing where government is. And then also on government side, government is also trying to extend its maturities and make sure that it has the needed relief to be able to go about its activities within the time frame. Now, we've spoken about what the reaction has been. We've spoken about what the deal really is about. Now, how does that translate into government's payments? Now, what the deal means is that, so this is the cash flow structure from the Ministry of Finance's documents that they shared on the agreement in principle. Now, what it means is that if holders of Eurobond should agree on this deal in July 2024, now as we speak, up until January 2037, averagely, government will be making payments of around 889 million US dollars every single year, right? What that also means is that based on the way the deal was structured in such a form that if you consent to be a part of the program, you receive a consent fee straight up in 2024. So even in 2024, even as we are going through a restructuring process, and even though we are under an IMF program, government, if the deal is agreed based on its cash flow statement, government is supposed to make around 477 million in payments to holders of Eurobonds who have decided to be a part of the program. So the maturity profile looks very scary. If you look at the principal payments that we have to make in 2026, that is one of the highest that we'll see within that time frame. And also in 2036, we are going to make very huge principal payments on the euro bonds that we have restructured, the new euro bonds that would come onto the market. So in 2026, you would have payments, cash flow payments, that is principal and interest of around 1.4 billion US dollars. But what does this, we've agreed on the deal? There are repercussions that are going to happen. What does this deal really mean for governments? What does this deal really mean for the international creditor? Now, on government side, government has been able to meet one deliverable in the deal that it has reached with the IMF. That means that the IMF is going to give it much more funding because one, it has been able to reach a domestic debt exchange program. It has been able to restructure most of its debts. It's now been able to reach an agreement in principle with Eurobond holders. So there's going to be inflows from the IMF. Now, what it has also done is that if government had interest payments to make in 2025, 2026, now all of those maturities have been extended. So you have 2027 papers, 2029, 2030s, all the way up to 2020, 2037. So government has extended its maturities, and that's a good thing for government because it gives it room to be able to prepare for those payments instead of them being at the front end. Now, the extra part is that government has reduced its principal payments that it's supposed to make. You remember that initially I said that everybody is supposed to receive a haircut of around 37%. So that will be a reduction in the principal payments that government was initially supposed to make. Now, also, the good part for governments is that you, in your old structure, you had roughly a volume weighted average coupon of around 8% in the outstanding bonds that you had initially before the restructuring. Your coupons were averagely around 8%. Now you've cut all of those that into 1.5% and 5% all the way to 6%. So you've made reductions in your coupon payments as well. Now, what's the bad part for governments? And when you look at the pros, you have to look at the cons. You have your currency problem still persists, right? So we currently have a currency that hasn't really exhibited stability for a very long time. So if you've agreed a deal, but if your currency doesn't stay as stable as it is supposed to be, you might end up having to pay more than was initially agreed in Ghana cedi terms. So our currency problem still exists. So that 1.4 billion that I spoke about in the previous slide could be a problem if your exchange rate moves from 15% to 25% within that time frame before 2027 or 2026. What that also does is that it limits you in the near term. So you've gone through an external debt restructuring, you've gone through a domestic debt restructuring. That limits your ability to be able to raise money aside the treasury bill option, really. So you've put yourself in a corner where you've now restructured your domestic debt, you've now restructured your external debt. So in the near term, you are sort of handicapped. What that also means is that within that time, if by some miraculous way you are able to raise money, people are going to attach a credit risk on your new issuances. So if you are supposed to issue at 8%, people can add based on their calculation of what risk they are incurring by buying your euro bonds. You could get around 1% or 2% in addition to the rates that you are proposing to issue at. So that would also be a problem for governments going into the future. Now, the last part is you have damaged your reputation in some form because for a very long time, you've been a country that has kept to its financial obligations. You made all of your obligations to the bilateral lenders, all your multilateral lenders. You've made all your commercial loan payments. You've done everything. But now, what this deal means is that you put yourself in the bad books of the international community, and then to some extent, the bad books of the domestic community as well. So for the international investor, what does it mean? Now, I spoke about some of the sweet deals, some of the sweet clauses that the international investor had put into the deal. So they are going to, the good part for them is that if certain events should happen, if Ghana's economy should turn around, they are going to be reinstated. What it also means is that they've created a system where governments, not that government hasn't been transparent, but they've created a system where they can clearly see where government is at in terms of its public debt structure. So they get to see that, and other investors who want to invest in Ghana also get to see that. Now, they've also included a provision that prevents governments from, undertaking any legal action against the new Eurobonds that they have also put out. Now, what's the bad part for them? If you're an international creditor, you'll be fuming because 37% of your principal now has been cut off. And that's not only the problem. Between December 2022, when you were told you were not going to be paid your Eurobonds up until now, you may have had payments that you had to make on certain important things, and you were curtailed in doing that. Now the agreement has been done, and you are going to receive a further 37% haircut on your principal as well. Your coupons have also been reduced in the new structure, and then also their maturities have been extended. So if you were expecting to receive a maturity in 2025, now because of the new structure, you could have a chunk of your new bonds in a 2037 euro bond after the domestic debt exchange in terms of the external creditors. So this is the picture of Ghana's market in terms of domestic and external. Now, if you know all of this, the onus lies on you to prepare for this market post people consenting to be a part of this program. So we've gone through this program. We've seen various terminologies. We've seen a payment in kind. We've seen a lot of memorandums. We've seen Dachi bonds. Being restructured, ESLA bonds. We've seen debt sustainability conversations, haircut conversations. And if you look at just a refresher on the old bonds, we had about 67 old bonds before the domestic debt exchange, and with a volume weighted average coupon of around 19% roughly. And then you moved from 67 bonds to 16 bonds if you are taking into consideration just the GOG, SLS, and Dachi bonds that were restructured into the new bond. So the good part is you've reduced all of this to around 9.1%. And we saw the reaction. Most people were not happy, including myself, because you had parents, loved ones, family members being trapped under this domestic debt exchange. And you could see the headlines: "Don't push pensioners into their early graves. Don't turn pensioners into destitutes. Uh, Pensioners' funds are equal to your pension funds." We saw very some level of extent, very harsh comments on the debt restructuring being wicked, being disrespectful, being unlawful, and being totally wrong. So the market is not happy about the debt restructuring that has happened, but we have to move on. And what that has meant for government is that it can't come onto the market to raise new bonds. The only section that it has gone through now has been through treasury bills. Now, what has it done through treasury bills? In 2023, averagely, so this is a maturity profile of all the maturities in 2023. So averagely, in the first half of 2023, from Jan 2023 up to June 2023, government had maturities of averagely around 8.2 billion in the first half of the year. Every single month, government was paying out 8.2 billion in maturities. In 2024, because of the very high rates that we've seen on the markets, even though they are declining, and the fact that government doesn't have any other option to raise money, what it has meant is that in the same first half of the year, now from the 8.2 billion that government was paying every single month, government is now making payments of around 14.8 billion every single month. If let's put that into perspective, in 2022 or in 2023, you were averagely raising around 3 billion or 2.9 billion every single week. Now, when you look at the auction results that come out on the BOG portal, you are raising averagely 4.3 billion every single week. So we've gone through a restructuring, but slowly what we have done is we are creating a problem for ourselves in the treasury bills as well. So that's been one of the shifts that we've seen in the market so far. And that leads us to a section where we want to discuss, okay, this is the debt restructuring that we've seen. We've seen certain shifts on the market. Does the data really speak to those shifts on the market? And that's what we go into in the very next session. So in on in terms of trading on the markets, we've seen that trades were going up onto the DDEP that we saw in 2022. Then now you've seen that generally trades have dropped. So the whole bar here constitutes the general trade, like total trading on the market. So for instance, in 2022, total trading on the market was around 230 billion. If you split that, the blue represents T-bill trade. So if you split that, about 17.25 billion of that are T-bill trades, and then the rest are other securities. Now let's go back and let's start from maybe around 2019. So around 2019, T-bill trades were around 3 billion roughly. And in 2022, when we saw the COVID-19 pandemic, it dropped. But you could see that T-bill trades were heading upwards. But around this period where we saw the DDEP in 2022, you realize that has induced a climb in treasury bill trade. So now out of the 98 billion trades that we saw in the whole of 2023, about 58%, 58 billion of that is T-bill trades. Now in 2024, you are seeing a very similar trajectory. Even as at June, we've done 48 billion in T-bill trades, and total trading on the markets has been around 72 billion. So if you look at where we are as of June, you could clearly see that by the end of the year, we would have surpassed the numbers that we saw in 2023. Now, so that's one of the shifts that we've seen on the market. A lot of trades in T-bills, which I think almost everybody is accustomed to. Now, the other shift that we've seen on the market is individual interest. So in December 2022, when you look at equity holdings on the market, foreign investors held about 16.6 billion, right? And you had institutions and firms holding around 4.4 billion. Now you had others holding around 921 million, and then you had SNIT here. Now the reason why we're not focusing on SNIT is because we've seen a change in individual holdings. So initially, the Central Securities Depository was not classifying individuals in their structure. They used to lump all of them as others. Now, what they have done is they've split the individuals and others. So now they've separated them. What you have seen is that investors have increased their holdings in terms of equities on the markets. So that's a change. Looking at December 2022 and May 2024, what we have also seen is that individuals have now grown much more interest in Ghana's equity markets. So it's something that you see generally across the markets because of the DDEP. People have grown much more interest in knowing what investments are, how their investments are doing. And it's not only with the Ghana Stock Exchange. On our side, we have seen a lot of interest from people, even for foreign equities, etc. So one of the shifts that we've seen also on the market is that investors are taking a much more stronger footing in the stock market within that span of time. Now, still on the stock market, which people are doing a lot of the trading. We've seen another shift here. So in 2022, full year 2022, if you split the trading by clients, foreign companies and institutions, so that's the very dark one, foreign companies and institutions. The very light one is local companies and institutions. The ash one is pension funds, and the very small one here is joint accounts. So at the end of 2022, for the whole year of 2022, if you were randomly trading with someone, about 66% of the time you were trading with a foreign company or a foreign individual or for a foreign individual. About 32% of the time you were trading with a local company or an individual, and 2% of the time you were trading with a pension fund. Now, if you look at that compared to what we see now from the GSE's numbers, now the the foreign investor is not really trading that much, right? So what it means is that they've either held on or bought securities that they feel that they can hold on to, or they are not doing much more trading and just studying the markets just to see where the opportunities are for them to take it. What we've seen is that local companies and individuals have dropped their trading frequency, and the largest trades that you see on the markets is with pension funds. So in 2022, you didn't have pension funds doing a lot of equity trading, but now you see that shift has been very clear, and pension funds are doing a lot of equity trading on the market. So that's one of the additional shifts that we've seen on the market. Now, to the fixed income side, we looked at, okay, we want to see what the change has been in holdings in treasury bills and then all other government bonds, including new bonds, old bonds, ESLA bonds, those that have been restructured, those that are still in the system. What you realize is that this is just for 2024. Since the start of the year, there hasn't been any change with commercial banks. You see the very slight drop from March to May. The reason why we don't have April here is because the CSD hasn't posted numbers for April, but they post numbers for May. That's why we have March jumping to May. Now, the twist here is that we've seen a very sharp climb in SNIT's holdings. So since the start of the year up until now, SNIT has been the largest buyer on the market in terms of fixed income. But then you ask yourself, what fixed income securities are they buying? what we saw from drilling down is that they've really been stacking up on the T-bill side. So with 91-day bills, 182-day bills, and 364-day bills. The other trend that we've seen is firms and institutions reducing their holdings in government securities. So you clearly see the picture. Also with individuals, you see that individuals are growing their holdings in 91-day bills, 182-day bills, 364-day bills, and even with some of the new bonds and old bonds on the market. The twist here is when you compare SNIT's holdings in the change that they have seen, and you compare them with pension funds or private pension funds have really distanced themselves this year so far from GOGs and from, I mean, GOGs in general. If you look at 91-day bills, 182-day bills, and all the new bonds and the old bonds. So pension funds have seen that reduction from January up until May. Now, what that does is that it raises a question of what really is their allocation like, and that has also been one of the main conversations that people have been having since the domestic debt exchange started, and it's mainly because if you look at in 2022 from the NPRA's annual reports, you had pension funds, private pension funds. This was their average asset allocation. They had about 78% in GOG bonds, and they had about 6% in local government bonds, and that's your SLS and Dachi. So if you put that together, that's around 84%. You had they had holdings in corporate bonds, etc., and about 4% in cash. What it meant was that if government hadn't given them a sweet deal as they had gotten, they would have been very much impacted by the DDEP that we are seeing. So since the start of the DDEP, pension fund managers, we've seen fund managers in general having taken a very critical look at their asset allocation and the kind of ways in which they've diversified their portfolios to ensure that they are sort of covered against certain risks that we have on our markets and their eggs are not put in just one basket. What we did was that we looked at, okay, what's Ghana's average pension fund allocation in 2022, and what is the average global pension fund allocation? And this was a very nice report put together by Thinking Ahead Institute. So they said that averagely around the world, as of 2023, the average pension fund allocation in the whole of the world was 36% government bonds, about 42% equities, 20% in other investments, and about 3% cash. So the others is real estate, etc. So it's a conversation that we can have even after my presentation. That what really is the ideal asset class allocation in in terms of your fund, and just to make sure that you have the right mix to be able to hedge you against some of the risks that we have on our market. So there's been a change in the way individuals think. There's been a change at the treasury bill, trading in treasury bills. We've seen a change in what Senate is doing in terms of fixed income. We've seen a change in who is really trading on the equity markets. Now, to the next thing is we've seen a shift in repo trades as well. In 2022, this was your repo trade trend, right? So averagely, around this period, your repo trades were around 19.3 billion, right? And after the DDEP, you hear people say that we are really in a repo market. But what it really meant, if you look at the numbers, is we hadn't really crossed the very high numbers that we are seeing in repo trades, right, around this period. If you remember, in November 2023, GIFM had a call on training the market on repo trades somewhere around November. And since that time, you see that repo trades have reached all-time highs. So the earlier notion that repos were really running the market as of the time weren't really accurate. But if you look at it and compare it to what we are seeing now, this is the time that you can really say that what we are seeing on the markets is a repo market based on the all-time highs that we have seen in April 2024 and May 2024. Now, those have not been the only shifts that we've seen on the markets. The very last thing we've seen is regulators also putting in an effort to make sure that the market has been deepened. You see the Ghana Stock Exchange come up with the commercial paper markets, the way it's going to be issued, the admission rules. We've seen them also issue launching the over-the-counter market as well. So there's been collective efforts even amidst the shifts, and that's helped the markets to stomach some of the losses that we encountered during the DDEP up until now. So you've seen the domestic debt exchange endgame, you've seen the shifts in the market. Now, where do we really go from here? And one of the very famous quotes that we always put up from one of the webinar calls that we had is one from Dr. Marlin Street Forest. And she said that it's not about really restructuring your debts, and it's really about a journey. If you really deep that, what you realize is that this is what Ghana has caused. By this is what all of us have caused by allowing governments to go in some of the deals that it has gone in. So this is the current maturity profile from July all the way to 2039 in old bonds, new bonds, cocoa bonds, pension bonds, local dollar bonds. So we converted the local dollar bonds and euro bonds at a rate of 15.3675 and treasury bills. What it means is that, and this is from July alone, you have about 106 billion in cash flow payments to make in old bonds, new bonds, cocoa bonds, pension bonds, local dollar bonds, euro bonds, and treasury bills. Now, if you roll over just this T-bill maturity that you have here, you pick this up because these have to be reissued and rolled over at rates that are not very conducive for governments on the markets these days. You roll over, you raise this and you put that here, and you roll that over and you put that here. You roll that over and you put that here. And what you have essentially done is you've created another problem out of a solution that you have already created. So that leads us to that conversation that we all need to have as a market. Reason why we are having this call is that if you don't go the restructuring in the best way possible, we are going to end up in the same way that most African countries have ended up on the continent between 1980 and 2020. So this is a graph that we got from the IMF. You look at Angola between 85 and 91, they underwent an external debt restructuring between 92 or so right after they restructured their external debt, they had to restructure their external debt and domestic debt as well. And then right after that also, they had to restructure their external debts. You look at Chad, they had a restructuring between 2014 and 2015. Now they had just 1 year, and then after that, they were back to restructuring their debts between 2017 and 2019. You look at Gabon, there's a similar story. They restructure their external debts between 1989 and 94. Then they are back again to restructure their domestic debts in 1999 and 2000. You look also at Tunisia, they have had a much peculiar story. You look at Seychelles restructuring their external debt in 1999, and they came back to restructure that debt again about 8 years within that gap. Right after that, they had to do an external and domestic restructuring again. So you get the picture I'm trying to create. If we do not go about the restructuring process in the best way possible, that serves the interests of every single market participant, that serves the best interests of this country, then we would end up being at a place that we already were before the restructuring. So a lot of African countries have ended up restructuring their debts, and some of those that don't have ended up going back to the IMF. So how many? So you look at those charts, and Liberia has been to the IMF about 24 times. You look at Kenya, they've been to the IMF around 23 times. Morocco 22 times. Mali 21 times. You look at Senegal 22 times. You look at Ghana 18 times. You look at Central African Republic 18 times. You look at Cote d'Ivoire, which is not here. They've gone there around 17 times as well. So it's I mean the picture is clear. If you don't go about the restructuring well, what you end up doing is you've cut down your debt, but because of the systematic vulnerability that you have in your economy, you end up going back to the IMF again. So averagely, for Ghana, when you look at the 18 times that we've gone there, we've we averagely go to the IMF around 2 years. Like every 2 years, we go to the IMF. If you look at Kenya, they go to the IMF averagely around a year. Liberia averagely around 2 years. So if you don't take care of the systematic vulnerabilities that you have in your economy, you are going to end up going back to the IMF for support, if not restructure your debts. Now, what did Jamaica do differently? And the reason why we talk about Jamaica is because there are quite a few similarities, and there are some things that we want to speak about. So they had a restructuring in 2010, and they ended up having another restructuring in 2013, which we do not want to have as a market. So what did Jamaica do differently, which we want to look at? Jamaica had an economic program to raise real GDP growth. They had a plan of reducing their debt to GDP ratio through an active debt management program. So they put together a system where they are going to actively manage their debts. You saw that they ensured fiscal discipline and accountability. You saw that they also maintained fiscal stability through structural and governance reform. So they cut their government at some levels to make sure that they have the right um, expenditure level to be able to grow their economy. And you also saw comprehensive tax policy reforms, which we can't do here because we see people complain about tax levels being high. We've seen what an increase in tax rates has done in Kenya. So it's not something that we can pick from Jamaica. That part, I'm not sure how it would really go well for Ghana and the government. So that one, I'll leave it to the discussion. So in a nutshell, Jamaica developed a system where they redeployed all of their interest savings from the restructuring to very key development sectors. So their healthcare, education, infrastructure, all in the bid to increase and boost economic growth. And those are some of the things that we would need to see, even as we try and close the deal with the official creditor community in terms of our Eurobonds. Now, the IMF came out with very good praise for Jamaica in 2019. They said that Jamaica's public debt is really on track, and it had met most of the things that the IMF had set for it. So there are things that we have to do, and beyond 2013, just like I said, I've broken them down again. We need to have an active debt management program. That is one. We need to have fiscal discipline and accountability. And one of the things that they did is they created an economic program oversight committee, and this committee had people who were in private sector, they had people who were in the public sector, and they had people who were in the civil society. And the main catch here is that this committee transcended governments. It didn't matter which government was in power. It was a committee that is set up in the best interest of the Jamaican economy, so that there will be someone or there will be a committee that would make sure that even if we are done with the program under the IMF in 2026, this is what Ghana, this is what government, this is what we are supposed to do to bring Ghana's economy into the right stance or to the right place that it's supposed to be. And what they also did is they increased the ease of doing business in Jamaica, which is what we have to do. We've seen in very recent times a lot of exits from the markets. We've seen Global, we've seen Dark and Lovely, we've seen a lot of other companies exit the market. We need to create an environment where it's easy in doing business, and that would help us grow our GDP. And when you look at that GDP, the debt to GDP equation, if you increase your debt to GDP, your GDP, you end up reducing your overall debt to GDP equation if your debt stays the same. So it's a two-sided thing that you have to tackle. Whilst you're tackling your debt, you need to tackle your production in your economy as well, so that overall you end up coming to the place where you are supposed to be in terms of debt sustainability. And then also your fiscal and your monetary policy should all be anchored on the debt restructuring targets that you have set for yourself. So we should see some level of cohesion between what the Monetary Policy Committee wants to achieve and what governments on this section also wants to achieve. So these are some of the things that Jamaica did. And it leads us to the very final slide on the possible game changes that we need to see on the market. So these points are non-exhaustive. we can add more in the conversation section where we talk about some of the things that we think on our very own government and regulators should do. And one of the things I put here is government needs to improve its macros. We've seen a very good trend in inflation this year. We've seen improvements in GDP numbers, real oil GDP around 4.7%, very impressive. But there's more that we can do. We also need to see fiscal discipline. And we know that in election years, we've seen very high expenditure levels and a lot of borrowing. We need to see some change in that. We also need to see changes from governments that would encourage private sector confidence on the markets. On the regulator side, we need to see a deepening of the market. And the GSE has done that very well. We need to see more issuances. We're seeing a lot of corporate companies coming onto the markets to raise money and just create that liquidity so that we can trade. You're also seeing very good initiatives from GIFM in making all fund managers and all market participants post prices at the start of every day, just to have a market where price discovery is at its highest level. So GIFM has done a very good job. GSC has done a very good job, but there's more that we can do, and I know there are lots of new initiatives that we can bring on board to make sure that the markets grow to where it is supposed to be. Now, on the very last point of information dissemination, what we realized when we had the brainstorming session is that when information comes from the GSE, let's say Atlantic Lithium has done so and so and so, what it does is that information just comes to the professionals on the markets. It doesn't really find its way into the general Ghanaian market. So you have people who may be holding securities in some of these, have positions in some of these securities, but would not get to some of these informations and insights if it is not broadcasted in a particular way that it is supposed to. So them posting on their LinkedIn channels. I've seen also Joy News having sessions with certain fund managers and certain brokerage firms on where they think the market is. And those are some of the things that we would want to see on the markets going forward so that collectively we can build this market in the right way that it should be built post a domestic debt exchange. So bringing this presentation to a final close, I came across a quote that I think every Ghanaian would relate to from the UNDP. So the UNDP had a collective program with the Jamaican government, which led to the restructuring of their debts. And one of the quotes that came from there is, every year for many years, we have been spending more than we earn. Every year, we have to borrow to make up the difference. So each year, the debt gets bigger, and each year we have to set aside more money to pay the interest on that debt. For the last 10 years, all the taxes we collect have had to be used to service that debt. So before we can pay one teacher or nurse or policeman, before we can patch one portal, before we can put one bottle of medicine in our hospitals, or provide one school lunch for a needy child, we have to borrow more money, piling up the debts even further, and the cost of servicing that debt even higher. So this is the picture of where Ghana is, and hopefully this is one that will not repeat and going forward. So that will bring us to the end of today's presentation. I hope you picked something from it, and over to you, Ernest, even as we have the discussion on what we think the market should be going forward. Thank you.
Great presentation. Thank you very much, Daniel. I believe all the participants on this call are really impressed with the insights that you've shared this morning. At this point, we are going to have a discussion. The floor is open. Okay, I already see Emmanuel Chance. Okay, it's a clap. Okay, it's a clap. All right. So the floor is open at this point. If we have any reactions or questions, if anybody seeks clarity on any of the slides or topics that was touched here, we would like you to come up. Okay, I see a message from Levina. Excellent presentation. Kudos to you, Daniel. However, I want to clarify that information dissemination by the Ghana Stock Exchange is very wide. Individuals are included in the mailing list. And in addition to that, the GSE makes use of the social media platforms. Lavina, thank you very much, and thumbs up to you guys out there. You are doing a great job. The clarity is well noted. The floor remains open for anybody who has a reaction, contribution, or question. It's sort of an open forum. We would like to hear what you think. We would like to hear your views. Let's share ideas. Let's all see where the market is headed. Probably I would take the first bite. So, Daniel, in the various case studies of the countries that had to go through another restructuring shortly after their maiden one, do we know the elements that resulted in the repetition of the exercise? What I'm really interested in is it the same securities or those debts that was restructured during the maiden time that got restructured again?
Yeah, so some of them had varied ones, some of them same securities, some of them different securities. But I think the underlining in all of the cases that I've looked at is if your revenue generation problems still persist, you end up having to come back to the markets to ask them to restructure their debt. So a classical example is what we see in Kenya. Kenya went through a debt restructuring some time ago. They tried to, curb the possible headaches that they could have with a 2 billion maturity that they had this year. What they wanted to do was to increase taxes so that they'll be able to rake in a lot of revenue to be able to make sure that the government doesn't have to go through that restructuring again. And the people spoke, and we all know what the final answers were. So revenue generation, if not in a very good um, position, ends up bringing us to the very same point. Also, you see in Jamaica's instance, for instance, after they had the restructuring in 2010, they went through a very difficult hurricane experience. So government had to go back to making a lot of, expenditure. So it brought them paces backwards in their restructuring journey. Also, some of the things that I've noticed also is with currency. When your currency doesn't show the stability that it's supposed to show, it ends up bringing you to the very same spots that you were before your restructuring. If you were supposed to pay 1.5 billion and your currency was around 4, and now you're supposed to pay that same 1.5 billion and your currency is around 15, then that becomes a problem because that depreciation of that or that loss in value of your currency has ended up becoming a bigger burden for you in terms of the obligations that you have to make. So it's a mixture of costs.
Well noted. I think that's satisfactory. Yes, Salom, we saw your hand up. Do you have a reaction or a comment, or it's a question?
Yeah, hi. Thanks, Ernest. So, I wanted to find out from Daniel regarding currency. What's your projection on currency for this year?
Yeah, I wouldn't want the ministry to come for me, but I know for a fact that based on the projections that we've done, we could end the year around 16. But miracles will happen, and policy strategy by the ministry and some inflows could have effects. So if I had a crystal ball, I could really tell. But from where I sit now, if you point a gun at me and ask me where currency would be, I would say around 16%, 16 cedis to a dollar by end of year, plus or minus. Yeah.
All right, thank you very much, Salom. And thank you very much, Daniel, for the response. Okay, so we have a question in the chat box, and this is coming from Michael. Michael would like to find out from market participants on the call what would they need to see from the market to be comfortable enough to start actively trading the new bonds aside macroeconomic improvement. So this is actually a question thrown to everybody on the call, I believe. And whoever wants to take a bite, the floor remains open. What would you like to see to start active trading in the new bonds? Is this something you would like to see from a regulator, from the government, or some fundamentals from the market? The floor remains open if anybody would like to share their views. Whilst we wait for views from others, Michael. Okay, Salom, you can go.
Yeah, and so this is more of a personal view. I think the question about when the market will kick in again has been asked for some time, especially after the exchange program. I think not all of it is technical in terms of the things that will get it to kick up again. So we've been through a certain experience as investors, both on the personal side and the clients whose funds we manage, and there's been a learning curve, right? So over time, we are learning that we need to diversify as much as possible. Due to the exchange program, the quantum of government exposure that funds would have increased because of the extra that was given, especially in pension funds. So there is a certain part that is due to nobody's fault, where uh, most investors hold so much government securities in their portfolio, and due to the experience of the exchange program, are looking to reduce that. So even though there may be other factors like pricing, I think that until investors get to a point where they feel like they have reduced their exposure to a particular issuer to to the bearable levels, maybe we may not trade more than we already are, and we may keep on doing the same levels that we have, or even try to reduce where the opportunities arise.
All right, thank you very much, Salom. You can lower your hand now, or unless you have another comment to make. Okay, all right. So that reminds me, I had a conversation with a gentleman some time back, and his argument or his point was that probably government shouldn't have actually restructured only the bonds. Maybe it should have been probably a 60-40 with respect to both the bonds and then also the treasury bills. In that case, we could have had both instruments trading. At this point, because of what happened to the bonds, people have shifted their attention to the treasury bills. And now from the slides that Daniel also presented, looks like that's also a time bomb. So if probably government had done the restructuring on both the bonds as well as the treasury bills, then the concentration wouldn't have been centered around just a particular option, and in this case, the treasury bills. There's also another school of thought who actually think that probably if so had happened, then maybe investors would have just shifted their attention from both the bonds and then the treasury bills as well. But I don't think that could have happened because investors don't have that much of luxury in terms of options. They need to give their money to here in Ghana. So that's also something I took away in my conversation with market participants. Now, Levina would like to find out from traders what they think the Ghana Stock Exchange as well as the Ghana fixed income market can do to improve transparency. Michael, you asked a question on what market participants would like to see before they can comfortably start trading in the bonds. Levina would also like to find out from you what you think the GSE or GFM can do to improve transparency.
Hi, can I be heard? Okay. Well, to be honest, I think the GSE and GFM have done their best. One of the things that people were looking at was the pricing of the new bonds. So looking at the daily GFM reports that was coming out, it was a bit difficult to separate negotiated transactions from pure transactions. So I think GFM took an initiative to bring out another platform or another avenue where you will be able to separate the sell buybacks from actual transactions. And I think that one has also helped the market a lot to be able to separate in terms of pricing, because sometimes when you see when people go to the Geffen report to go and check out the prices of the securities they have, I want to believe that some of them use that to mark their securities in their books, and also it's a reference point to be able to see where the securities on the market are trading at. So I think for now, the best thing for GIFM and GSC to do is to publish information which they have been doing religiously. It's really like Selom said, there has been that level of exposure to the market where with the issuance of with the bringing up of the DDEP, there were a lot of bonds now in portfolio. So even if you do just a little more on treasury bills, it all adds up to government securities, right? It doesn't segregate whether it is government bonds or government treasury bills. So there has been that upper limit where portfolios have been saturated with the government of Ghana treasury bills, and even when it comes to regulatory wise, you would not be able to take on more security. So there has been the need to diversify. So GIFM and GSE, I think they have done their best, and what is left is to see foreign investors trying to have an understanding of what the new situation on the market is now, because the old bonds are gone. I mean, this is what we have to work with now. So for the market to open, I think because they are also one of the main players in the market, we have seen that there's interest there with respect to the bids that we are seeing. But unfortunately, when it comes to the pricing of the security, there's no need for some of these market participants to take the losses, because if you see what has been done to the bonds, now the bonds are starting from mid end to the long end, and we know what duration does to some of these securities. So just a little movement in price is going to, depending on whether it is a plus or minus, is going to greatly affect your portfolio positively or negatively. So we see the bids out there, but unfortunately, they are not levels that market participants can touch. If there is no pressing need for liquidity, you will just mark them in your books as where they are. And if there is a need to sell, you would come to the market and have to sell at market levels.
Thank you very much, Michael. Any other questions or contributions or reactions? The floor remains open. AJ, you are muted. AJ Boateng, you are muted. Are you talking?
No, I've just been thinking about risk management from some of the things that Daniel presented in his earlier slides. And I think from just listening to it, the external sort of bond restructuring means that, like, ultimately the external foreign investors have sort of removed themselves from sort of immediate sort of Ghana risk for now, and as such, all the risk, because of the over reliance on the domestic sort of treasuries, means that the risks are purely domestic going forward. That was one thing I took from it. The other bit, which I thought was also quite eye-opening, was that in terms of the power versus the disco conversation, if we've just taken an IMF sort of a facility of 3 billion, and we're saying that those who are going for, perhaps as part of sort of agreeing to these external invest sort of as part of the foreign sort of agreement, means that we're having to pay them 400 million out of the 3 billion. It just makes you really question whether where the real incentive in terms of for Ghana as in going forward. So those were the two things in terms of the 400 million that will be paid to the participants, but also the nature of how the treasuries have become the only sort of place in which the government resort to, means that going forward the risk is predominantly domestic. I think those were the two things that I took from it. So Daniel, thank you.
Right. Thank you very much, AJ, for your input. Any other questions? The floor remains open. Or reactions. It's a discussion, like I said. So if anybody wants to share their 2 cents, the floor is open. If you have more questions for Daniel too, we can take some 2 or 3 questions before we wrap up. Daniel, in your presentation, we saw some reforms from the Jamaican perspective. If you can even shift your slides to that particular page. Clearly, those reforms are reforms we've also heard our leaders actually pinpoint. We've seen all of that. They've mentioned all of that. And the problem with our part of the world, I see it in implementation because Ghana as a country actually has some lovely policies that if we were to implement them, hopefully, I think we would have attained the desired results. But we have beautiful policies, but when it comes to implementation, we end up being a little bit lackadaisical or very conservative. We don't go hard on the enforcement. And that also brings us to the virtual cycle that we all dread of. Now, at this point, where do we even draw the line between fiscal discipline and all these communist bailouts or socialist socialist activities that we see our governments undertaking? Just recently, just right after this Eurobond conclusion, we saw our government actually making available 1.5 billion Ghana cedis to be dispersed to customers affected by the banking sector cleanup. So it looks like in our part of the world, at every point in time, there are some socialist or communist exercises that the government actually needs to bear. And then also, it makes us find ourselves in a particular situation where we go out there and we borrow, and we need to spend all these monies on ventures that actually do not earn us income. And that is where the fear lies. Borrowing or debt in itself is not a bad thing, actually. But when you take the debt and you don't invest these monies in a profitable venture or in a venture that would earn you income, that is where the struggle comes in. When we borrow and we are using it to refinance a certain debts or we are using it for consumption, that becomes a Herculean task for us. So it makes it difficult for anybody to even hit their chest and say, we are not going to repeat the business of going back to the IMF. And it's scary, especially seeing all these countries that you listed having to go back into doing a debt restructuring. Based on what we see, if something fundamentally doesn't change, looks like that's where we are headed. And that's actually my concluding comments. Daniel, can we have your closing remarks if there are no questions from anybody else?
Yeah, and that's a very good way to wrap everything up. Um, I think we need to be very strategic. In project management, if you're starting a project like this, you need to put out a project charter to state what your deliverables are. You need to have an action plan, and I think that's what we should have going forward. For an individual, my final remarks for you is that you need to keep a very close eye on the grand maturity profile going into the future. You need to have exposure outside Ghana. You need to take the opportunities that you see on the market. And with all of that, Blackstar can help you. So just give us a phone call and let's do some business. Thanks.
I thank you very much, Daniel, for your time today and the content of your presentation. Thank you to everybody who participated, including those who didn't comment, but we know you were following actively. We thank you all. Just to remind you, Black Star is a PD and we are always available to tender in your bids. Our global markets team is also poised in helping you execute all your trades on both sides. We also have an active fund manager that manages um, most of the highest performing funds on the market. And so we are always available to assist you if you're interested in any of these funds. We also have a very poised advisory and capital markets team to assist you in all your endeavors. Thank you so much for joining the call today. You can follow our social media channels for more of these analytical works. Thank you and have a great business day. Bye bye.